Now, next we will move to the second type of strategies, which involves trading an option, its underlying asset. Again, we will be focusing only on stock options. However, the strategies that we will examine are not limited only for stock options. You have to keep in mind that there is an unlimited variety of payoff patterns that we can achieve by combining calls and puts. Okay. Now, and we whenever we are examining now the strategies involve trading an option and the underlying asset, we need to look at the implications of the call put parity. So let's examine the first strategy, which is given by chart A. In chart A, we took a position in the stock and we took a position in the option. What is the position in the stock and what's the position in the call option, in the option? Well, first, we notice that as the price increases, the position in the stock or of the position in the stock will increase. So the only position that has a profit that increases with the underlying stock price is a long position in the stock. So in A, we are taking a long stock. Okay, what are we observing here? We are observing a call or put option. First, there is a payoff as the price increases. So it's a call option. Second, the payoff is so as the price of the underlying increases, the payoff or the loss increases, which means we are taking a short call. Now the short call and the long stock combined, they create what's called a covered call. So we have a short position in the call and we cover it by taking a long position in the stock. Now the combined payoff of the long stock and the short call is by the red line. And that line is similar to what? It is similar to a short put. Now, can we guess or can we predict that if we took a long in the stock and a short in the call, we will create a synthetic put position? Let's see. If we examined the put call parity, now this is the put call parity for European options. Now we ignored the dividends. So in the put call parity, the price of the call or along in the call, along in the put plus along in the stock is equal to along in a call option plus along in a zero coupon bond that has a face value of K. Now if we did some arrangements, a short in a call, okay, and borrowing a certain amount of cash plus a long in the stock will yield a position that is similar to taking a short in the put option. So just rearrangements. We take P to the other side, the present value of K to the other side, and the present and the premium for the call option to the other side. We will achieve this equation, which represents a short in put option. How about graph B? Now in graph B, it's essentially the opposite of the positions in A, which is a short in a stock and a long in a call option. And when we combine them together, it is called an inverse or a reverse, sorry, a reverse covered call. Okay. So we took a long in a call position. We took a short in a stock. We created a payoff combined of these two positions, similar to taking a long in a put option. And we can basically see that this is the case if we examined the put call parity again. So taking S to the other side, now we have a long position in a call option, a short position in the stock, plus a long position in the zero coupon bond will give us a long synthetic position in the put option. Okay. The strategy represented in diagram C is basically a position in the stock and an option. Now, which position in the stock? Well, similar to A, it's a long position in the stock. So we have long stock, and we have now, what is this position? The call, long, short. Well, since first the payoff is positive, it's a long. And since the payoff increases when the price of the stock decreases, then it is a put option. So we are taking also long put. A long put create what's called a protective put. The covered call and the protective put are the most strategies that involves the option and the underlying. And the protective put is a basic implication of the put call parity. So a long in a put plus a long in a stock will give us a combined will give us a payoff that looks like a call option plus combined. We created a position to a call option. So we can create a synthetic call option by taking a long in the stock and a long in the put. The final diagram is basically a short stock and the short put, and combined will create what's called the reverse protective put. Now, the reverse protective put is the strategy that I don't believe any investor will be willing to create, because we are essentially creating a short call. And a short call is the most risky strategy among all four positions. Now notice here that the covered call is not risky anymore compared to the short call. Why? Because the stock we have will cover our exposure in case the price of the stock went up. So no matter how high the price of the stock will go up, I already have the stock, so if the counterparty exercised, all what I need to do is to deliver the stock and I will receive the strike price. Now we will look in more detail at both the covered call and the protective put. We have to keep in mind whenever we are designing a covered call, the ratio of the call options and the stocks has to be 1-to-1. So if I shorted one call option, I need to take one long position in the stock. I shorted 100 call options. I have to cover it by owning or buying 100 stocks and so on. The profit equation for the covered call is basically we combine the profit equation for the stock and the profit equation for the call option. Since a long position in the stock, N will be positive, and since we took a short position in the call option, N will be negative, NC. Now, if the call option is in the money, then the profit will be from the covered call will be K minus 0 plus the premium we received. Why K? Because I'm going to receive K, the strike price, and I paid S0 to buy the stock, and I received the premium from shorting the call option, so that will be my profit. If the option expired out of the money, so basically I have to sell the stock at whatever the price available in the market minus the price I paid for owning the stock plus the premium I paid. Let's look at the profit diagram for the covered call. Compared to just taking a long position in the stock, what do you notice? We need to look first at the break-even point. So the break-even point for the covered call is 112.44, which is lower than the break-even point from buying the call option, buying the stock only, which is 125.94. Why that's the case? Well, remember, in the covered call, I'm going to short a call option, so I will receive the premium. Now, this premium will reduce the cost of the strategy, right? Because I received the premium, I paid 125, so it is as if I paid net 112.44. We see that the break-even point here is lower than 125, right? So it is providing me with the cushion in case, or a buffer in case the price went down. So I will not start incurring a loss until I exceeded or the price declines below 112.44. If I did not enter into a covered call, I just bought the stock, well, at any price lower than 125.94, I will incur a loss. So this is one of the advantages of the covered call. How about the upside potential from the covered call? Well, since the call option has a strike price of 125, at any price above 125, the counterparty will exercise, which means that he will buy the stock from me for 125. I paid for it 125.94, so I'm going to lose 0.94, but I received 13.50. So net, I'm going to realize 1,256 for the 100 options that I shorted. Why 100 options again? Because remember, we are dealing with options that are traded in organized exchanges, and in organized exchanges we can only 100 or short or long 100 options. So my maximum profit will be 1,256. Now, if you want to compare the return that we will achieve if we realize maximum profit, so 1,256 divided by how much it cost me to create the strategy, which is the break-even point times 100. So in 1 month I will be achieving 11%, 0.11 approximately, as a return in case the call option expired in the money. If the option expired out of the money, and the price was above 112.44, then I will realize a profit, but it depends on what's the level of the stock price. If the price went down, then I will realize a net loss. So you can see the advantage of the covered call is that it lowers the break-even point, but this is not without any cost. We are sacrificing the upside potential. So we can see here, as the price of the stock increases, in the long stock only, my profit will increase. But in the covered call, my profit is capped at 1,256. So I'm sacrificing the upside potential for the sake of decreasing the break-even point. Now, what's the maximum profit for this strategy? Is basically the strike price I'm receiving minus the price I paid for the stock plus the premium I received. What is the maximum profit? What is the maximum loss? It's the price of the stock plus the premium I received, and that's when the price of the stock reaches to 0. So that will be the maximum loss or minimum profit. If you want to analyze quickly the effect of the different exercise prices, well, we have to look at how the strike price will affect the intrinsic value of the call option, which in turn will affect the premium we will be receiving from shorting the call option. So there is a negative between the intrinsic value and the premium of the call option, and since we are receiving the premium, if we choose an option with the highest strike price, well, it will provide us with the with the highest break-even point. If we choose the option with the option with the lowest strike price, it will provide us with the lowest break-even point. So which strike price will give us the highest protection against the downside movement in the underlying stock price? It is the option with the lowest strike price. Why? Because it has the highest premium. But in terms of the upside potential, which strike price will provide us with the highest profit? Well, the option with the strike price 130 will provide us with the highest profit because the premium I paid is lower than the other options, right? So if that's the case, then and since the counterparty will not exercise until the price exceeded 130, then any movement in the stock price, I'm going to realize it for my as a gain for my side until we reach 130. After 130, the counterparty will exercise, so I will sell the option with the strike price 130. Plus, compare now, since I'm receiving the strike price and I 125.94 and I receive the premium, so the option with the highest price will result in a higher profit. Option with the lowest strike price will result in a lower profit because I'm receiving the strike price, right? And the strike price is lower, so my profit will be lower. If we want to examine the effect of keeping the option for different holding periods, well, it's the same intuition that we followed when we discussed the cases for call and puts only. Here we have T, which is the expiration date. Here we have T2, which is lower than T1 but higher than T2. Higher than T1. So T1, T2, and T. And we know that T1 is smaller than T2, which is smaller than T. Now, why we observe that at any level of the underlying stock price, always the shorter holding period will have the lowest profit. It goes back to the relationship between the time value and the option price. Now, at time 0, we took a short position in the call option, right? At time T1, we are going to close our position in the short position, which means we are going to buy the call option. So we will pay the premium. When I pay the premium, I'm going to pay for a larger part of the time value, assuming that the intrinsic value is fixed, because we are looking at a fixed level of the a certain level of the stock price. So if I'm going to pay for a larger part of the time value, then my profit will be lower because it cost me more to buy back the call option. If we waited until the time to expiration, then I'm not going to pay anything for the time value, right? I'm just going to pay the intrinsic value. And that's why the profit will be the highest when we wait until the time to expiration of the call option. Okay. Now, next, let's look at the protective put. So, the profit equation for the protective put is basically the profit from the stock plus the profit from the long put option. If ST is greater than K, which means the option will expire out of the money, then the profit will be ST, the price I'm going to sell the stock for, minus the price it cost me to buy the stock, minus the premium I paid for the put option. If the put option was in the money, which means it makes sense to exercise, my profit equation for the protective put will be the price I'm going to receive when I exercise the put option, minus how much it cost me to buy the stock, minus the premium I paid for the put option. So here we'll illustrate the profit diagram for the protective put. Now here we are looking at a protective put of a stock that cost 125.94 and a put that cost 11.5, and the put option expires in June with a strike price 125. Now we want to compare the protective put with only taking a long position in the stock. What do we notice? Well, first, what do you observe about the break-even point? Which position has a higher break-even point? The protective put or only the long stock? Logically speaking, in the protective put, I'm buying the position and I am buying the stock, so the break-even point will be higher because of the cost of the put option. Okay, how this will affect our profit? Now, we still have an exposure to the upside potential. However, compared to only the long stock, in the protected put, we will always realize a lower profit compared to the long stock only. And the difference is because what? It's because of the premium we pay for the option. Okay, so why we are sacrificing this profit? We are sacrificing this profit because it will give us a protection in case the price of the stock went down. So if the price of the stock went down, I have a put option, which means I have the right to sell the stock for 125. So at any price lower than 125, I protected myself by being able to sell the stock for 125. So there is a floor for my value of the stock, which is 125. Now 125, if we reduce from it the premium we paid, so the maximum loss we will realize is 1,244. It cost us to buy the stock 125.94. We are going to sell it for 125, and we paid 11.50 for every put option, so the maximum loss will be 1,244. Okay, so the advantage of the protective put, it protects us against the downside movement in the underlying stock, but we are sacrificing some of the profit in the upside potential of the underlying stock. What's the maximum profit? Well, it's similar to a long position in a call option. It has an infinity. There is no maximum, but the minimum is basically the difference between how much I'm going to sell the stock by exercising the put option, how much it costs me to buy the stock, and how much it costs me to buy for the premium. You can think of it as you can think of the put here as an insurance policy. Quickly, we examine the effect of choosing different strike prices. Well, the relationship between the strike price and the put option price is what? Is positive or negative? Well, what we learned in chapter 11 is that there is a positive relationship between the put option and the strike price. The intrinsic for the put option is the maximum between K minus S 0. So if we increase K, we will increase the intrinsic value, and if we increase the intrinsic value, the price of the put option will increase. What does this mean? Well, it means that for a protective put, the highest strike price will result in the lowest in the lowest loss. Why? Because I'm able to sell the stock for higher strike price. However, if the price of the stock went up, I'm always going to achieve the lowest profit because I paid the highest premium for this option. So an option with a strike price 130 will yield us we will pay the highest premium, which means the break point will be the highest among the three other options. So we can see the trade-off. We choose a high strike price, we will achieve a lower loss, but we will always achieve a lower also profit. If we chose the put option with the lowest strike price, well, we will pay a lower premium, right? So we will have a lower break-even point, plus not only lower premium and also lower extra price. So the break-even point will be lower. However, if the price of the stock went down, we will achieve loss or the highest loss. If you want to examine the effect of the protective put and the time to expiration, or the keeping the protective put for different holding periods, well, again, we need to examine how the protective put will behave under different holding periods. So, as what we saw before, time to expiration T, and we have time T1, which is smaller than time T2. So T1 smaller than T2, smaller than T. Now, why we observe for any given level of the underlying stock price or any given level of the intrinsic value, always the shorter holding period will result in high profit. It comes back to the fact that at time zero, did we long the put option? For protective put, we take a long position in the put option. So at time T1, I'm going to sell the put option, which means I'm going to receive a higher part of the time value compared to time T2 and time T. That's why we will observe that a shorter holding period will result in a higher profit compared to keeping the position until time T2 or waiting until the option will expire.